The 30-year Treasury yield just spiked to its highest point since 2007. And I know what you're thinking. Okay, cool. Why should I care? Fair. Because honestly, Treasury yields sound like the kind of thing only guys in fleece vests talk about. You know, the ones sipping $9 lattes and bragging about their portfolio allocation at dinner. But here's the thing. That boring little number? It's basically the price of money. It sets the borrowing cost on trillions of dollars of debt. And right now, for the first time in almost 2 decades, it's flashing a warning. But the headline isn't the real story. The real story is what that number is quietly breaking underneath the surface. And it's happening inside a $2 trillion corner of the market that most people never look at. And here's the weird part. Even as rates climb and the warning signs pile up, half the industry is out there saying, "Relax, everything's fine." But both of those things can't be true at the same time. And that's exactly why this is so interesting. So let's back up. Because to get it, we've got to start with that one number. When the US 30-year blew past 5%, at least it had company. The UK's 30-year hit its highest level since 1998. Germany's climbed to levels not seen since 2011. And Japan? Their 30-year just hit an all-time high. So when 4 of the biggest bond markets on the planet start acting like a meme coin after a random tweet, yeah, something's up. Because the bond market is supposed to be boring, predictable, the adult in the room. But right now, while everybody's staring at stocks going vertical and the AI hype train, that adult quietly walked over and shut off the music. So let's do a quick 30-second crash course. Because the why behind these moves is the whole story. A bond is basically an IOU. A government, a company, whoever. They borrow money and hand you a piece of paper that says, "I'll pay you back plus interest on this date." People bid on that paper, and what they're willing to pay sets the yield. Here's the key part. Bond prices and yields move in opposite directions. Buyers swarm in, price goes up, yield goes down. Nobody wants it, price drops to lure buyers and yield goes up. Price down, yield up. Price up, yield down. Got it? Good. So when yields are climbing everywhere, it means buyers want more reward before they'll lock up their cash. And that happens for 4 reasons. 1. The Fed. They set the baseline rate. If they bump it to 5%, nobody wants your old bond paying 3%, so you slash the price to sell it. 2. Inflation. If your dollars are going to be worth less later, you want more up front. 3. Supply. The U.S. is pumping out new debt like it's Costco. Eventually, you run out of eager buyers. More supply, lower prices, higher yields. And 4, demand. The big players, foreign governments, pension funds, if they start doubting the U.S. can handle nearly $40 trillion in debt, they back off. And when they back off, prices fall until someone bites. Now here's the twist. The long-term yield isn't even the scariest part, because if the Fed is good at one thing, it's shoving today's problems onto tomorrow. But some problems can't wait, and the real pain right now? It's on the short end of the curve, and the Fed's fingerprints are all over it. That rate is called SOFR. Think of it as the daily receipt for the entire U.S. financial system. It tells you what borrowing overnight actually cost, based on real trades, not guesses. In early 2022, SOFR was basically 0. Then the Fed started hiking. By mid-2023, it was over 5%. And even after a year and a half of cuts, it's still higher than before the pandemic. And when rates jump that fast, there are consequences. See, most people think of debt like a mortgage, fixed rate. You lock it in and your payment never changes. But there's a whole other world called floating rate debt, and it works the opposite way. A floating rate loan doesn't lock anything in. It picks a benchmark, almost always SOFR, and adds a little extra on top. So if SOFR moves, your loan payment moves right along with it. SOFR goes up, your interest goes up. And I think you can already see where this is headed. Which brings us to private credit. Private credit is basically private lending. It fills this weird middle zone. Companies too big for a small business loan, too small to sell bonds on Wall Street, too messy for a normal bank. So they borrow from private lenders instead. And these loans have two features that explain everything. First, they almost never trade. There's no public price. Their value gets estimated, usually once a quarter. Remember that. It matters later. Second, most of them are floating rate, which means when SOFR jumps, borrowers get squeezed. Payments rise, cash gets tight, and there's way less room for error. And the cracks? They've already started. Take Pluralsight. Back in 2021, a private equity firm bought it, funded partly with over $1 billion in private credit loans. Total price tag, north of $3 billion. And that debt landed right on Pluralsight's books, floating rate, tied to SOFR. For a few years, no problem. SOFR was near zero. Then it shot past 5%, and suddenly Pluralsight was drowning. It was over. The lenders had to step in, swap their debt for ownership, and pump in another $275 million just to keep the lights on. Their reward? 85% of the company. And that's just one example. It reminds me of something JP Morgan's CEO said on an earnings call. When asked about cracks in the credit market, he said, "When you see one cockroach, there are probably more." Brutal. But he's right, because the data backs it up. Earlier this year, a major default rate tracking hundreds of these borrowers hit 6%, the highest ever recorded. And here's why that's scary. This market has exploded, up nearly tenfold since 2007, and almost all of it runs on floating rate loans. Pluralsight wasn't special, it was just first, which means a whole stack of companies just got hit with the exact same rate shock. So how is the industry showing record defaults while acting like everything's totally fine? 2 words, sneaky accounting. It's called a payment in kind feature, a PIK, and it lets a borrower pay their interest with something other than cash. Yeah, read that again. Interest, the whole point of lending, paid without actual money. So when SOFR spikes and a borrower can't keep up, the lender goes, "No worries, just pay in kind," which is a polite way of saying, "Don't pay." The unpaid interest just gets tacked onto the loan balance instead. Normally, when a borrower can't pay in cash, that's a default. It triggers restructuring, bankruptcy, the whole thing. The loan gets stamped non-performing. Everyone sees the damage, but a PIK erases the trigger. Technically, no payment was missed, nothing defaulted. The loan looks perfectly healthy, even though zero cash showed up. And it gets worse, because the lenders, the private credit funds, count that unpaid interest as income. Income on money they never collected. Now stack this on top. A huge chunk of this market runs through funds called BDCs. They get sweet tax treatment, but in return, they're legally required to pay out at least 90% of their taxable income to investors. See the problem? A company sliding toward collapse shows up as a healthy, income-generating asset. The interest it can't pay gets added to the loan. The fund reports that as income. And then, because it has to, it mails out cash dividends on money nobody ever actually paid. So the higher rates go, the worse the borrower does, the more income the fund reports, and the bigger the dividend it sends out on cash that doesn't exist. That's the trick, and it's spreading fast. Roughly 11 to 12% of these loans now use PIK features, up more than 70% since 2021. And over half of those are the bad kind, added after the borrower was already struggling. And there's one last layer. It's not just about the income, it's about how these loans get valued. Since they never trade, there's no real price, so they fall into a category called Level 3, the most subjective, made up behind closed doors type of valuation there is. No market data, just internal models and vibes. And recently, analysts found more than 10% of these loans had already been marked down by at least 50 cents on the dollar. That's the wave building quietly in the background. People call it the private credit maturity wall, around $85 billion in loans coming due between 2026 and 2029. And when that hits, all this cheap debt has to be refinanced at today's rates. Somebody's going to have to face the music. So if you want to watch this unfold in real time, not read about it after the fact, hit subscribe. Because this story is just getting started, and I'll be tracking every crack as it appears. Because here's the truth. You can hide a loss in an accounting line. You can roll unpaid interest into a bigger balance. You can even call a dying company healthy. But the math is still the math. And bad math doesn't just disappear.